Hello everyone, and welcome back to our Binary Options Basics series. In this video, we'll discuss the payout levels from the options brokers and what that means for you as the trader. You'll learn how to use these payout levels to analyze individual trades and to evaluate your overall trading strategy. In addition, you'll gain some insight into the trades from the broker's standpoint by learning about the broker's spread in the transaction. So let's start. The first thing we're going to do is we're going to go to the Bank Day Binary Options Trading screen. At the top is the currency pair EUR and USD. At the bottom is the currency pair AUD versus USD. Let's look at the bottom option, which expires in just a few minutes. The currency pair is currently trading at about 1.016, and the site is constantly updating the strike price to be equal to the current trading level. This binary option has a potential payout of 75% of the initial investment, and the payout is the same whether we're interested in a call or a put. This means that if we're correct in our prediction, we will earn back our initial investment plus an additional 75% profit. Let's say we analyze this pair and we decide that we think the price is going higher. In that case, we'll click on Up. The trading box will ask us to enter an investment amount. For now, let's enter $100. In future videos, we will discuss how to allocate your trading capital across multiple trades. So we invest $100. If we're correct, we will earn our initial $100 back plus an additional $75, a total of $175. How do we decide if this is a good investment? Well, let's think about it in terms of probability. In a binary option, as the name implies, the outcome is binary. That is, only two outcomes are possible. The first possible outcome is that the asset finishes below the strike price, in which case we lose our $100 investment. The second possible outcome is that the asset finishes above the strike price, in which case we make a profit of $75. We want to know the probability that we're correct and the asset finishes above the strike price. Let's call that X. The probability that we're wrong and the asset finishes below the strike price is 1 minus X, since those are the only two possibilities and the probabilities must sum to 1. The expected value of this trade is represented by this formula: 75x plus a negative 100 times 1 minus x. And for our trade to be profitable, it must have a positive expected value. So let's set this expression greater than 0. Solving for x, we get a probability of at least 57%. Therefore, the probability that the asset finishes above the strike price must be at least 57% for us to make this trade, and the probability that the asset finishes below the strike price must be less than 43%. So what does that mean for the trader? Well, there are two ways to think about it. The first way is as a deciding factor for the individual trade on a standalone basis. If we buy the call option, we're saying that we think there's a greater than 57% probability that the asset will be higher than the strike price at expiration. For example, if we think there's a 75% chance that the asset is going higher, we should of course do this trade. But if we think there's only a 50 or 51% chance that the asset's going higher, we should not do this trade. So not only do we have to think it's more likely than not, but we have to be fairly certain that the asset's going to be above that strike price in order to do this trade. The second way to think about this is as a way to evaluate our overall trading strategy. If we were to invest in a portfolio of binary options each day, we can assume that we're not going to make money on every single trade. To make money every day, we'll need our success rate, that is, the percentage of profitable trades, to exceed 57%. That's assuming they all have that same 75% payout potential. If we're not able to meet this hurdle and we're finding that day in and day out our success rate is lower than 57%, we're going to need to reevaluate our trading strategy. So this is why it's so important when it comes to your trading strategy that you're very confident in your trades. It has to be more than 57% chance in this example that the asset's going to be above that strike price at expiration. When it comes to a long-term successful trading strategy, there's another numerical analysis that we need to discuss, and it's related to the 75% payout and our success rate. And that number is the broker's spread for the options. So think of the broker as the casino for a blackjack bet or a bookie for a sports bet. The broker's goal is to make opposing trades and lock in what's called the spread. So what is the spread? Well, remember, the broker pays out 75% of the initial investment on a put or a call. They give the same payout. Let's take a simple example where the broker has one underlying and one strike price. Let's assume the broker is successful in building a book of puts and calls in exactly equal amounts. When the option expires, only one of the options will be in the money, either the calls or the puts. Let's say it's the calls that expire in the money and pay out the 75% profit. The put options will expire worthless, and the broker will collect 100% of the investment for the puts. The broker's net profit is the 100% that they receive from the put buyers minus the 75% that they pay out for the call buyers, for a net of 25%. That 25% is called the spread. In theory, if our trading strategy was not advantaged at all, where we were equally likely to be right or wrong on each trade, then we would just consistently day in and day out be losing that 25% spread over time. In order to make money, we need to be right more often than we're wrong in order to pay for that broker's spread. So that's why it's so important that we develop a smart trading strategy.